Matt here from Sharpe Medical Accounting. I hope you're well. As you'll have seen from the mainstream news, there's been some significant changes to the pension tax legislation this week, which will affect so many doctors across the country, and in a good way at long last. We've got some good news to talk about. So I want to just recap some of the key points here to make sure that everybody's entirely clear with what this means for the future, how it impacts upon your role in the NHS going forward, and potential tax liabilities. So let's just start from the very beginning here and recap what these pension taxes are all about. So every year that goes by, if you are in the NHS pension, you have these deemed, and the key word is deemed, pension growth. So let's say you're in the old scheme and the new scheme, so the 1995 scheme and the 2015 scheme. Based on numerous factors, those pension pots often grow. So it's not uncommon to have, let's say, £20,000 growth in the 1995 scheme and, say, £40,000 growth in the new scheme. What we have to do then is we have to say to ourselves, well, what's the total growth throughout the year? Obviously 60,000. And we have to compare that figure, this deemed hypothetical growth figure, against the annual pension tax allowance. Now that is currently £40,000. So in the example of the doctor who has had £60,000 growth, he or she would say, well, I've not had this money. It's a hypothetical figure, a piece of paper, it's a paper item. But my growth is considered to be £60,000 for this tax year. My pension input allowance is £40,000. The surplus of £20,000 is taxable at the marginal rate. So if you're a 40% taxpayer, you would pay 40% tax on £20,000 worth of excess growth. If you're earning £150,000 plus, then you would pay 45% tax on that taxable surplus. And it is no surprise that doctors have become really annoyed by this. It's a tax almost catching them broadsided. A tax being paid out of income that they've not yet received. And then we naturally have the question of, do we just pay the tax now, or do we elect for the scheme to pay it? So that's another decision for later on. But I hope that makes it clear as to where the issue lies. It's deemed hypothetical growth versus the pension input allowance. And the real good news from this budget is that instead of having the allowance at 40,000, from the beginning of the new tax year, that allowance is going up to 60,000. So a 50% increase in the standard pension input allowance. This is bound to take many doctors out of this problem. I mean, I just off the top of my head, and thinking back to the 2022 tax year, again, this is just gut instinct, but I feel that I saw maybe more than 50% of our client base had growth between maybe £40,000 and £50,000. So that group of people who were so inconvenienced in years gone by will no longer have the problem. In fact, if they've got, let's say, £50,000 worth of pension growth going forward, they'll have £10,000 worth of unused allowance to carry forward because the allowance is now set at 60,000. So it's bound to be good news. It will take a lot of doctors out of this problem. We'll have to wait and see how many people do fall out of this problem, but there is no doubt that it's a move in the right direction. Something, though, that you should be aware of is, whilst I'm confidently saying to you that the new pension input allowance is 60,000, be careful of tapering. So if your total taxable income exceeds £200,000, your pension input allowance of £60,000 could be reduced. So let me give you an example. NHS doctor earns £120,000 NHS salary. That's NHS taxable pay of £120,000, but also has £100,000 sole trader profit. So that's £220,000 worth of total taxable income, or threshold income, as they might say. And you could include in there dividends and buy-to-let property income and foreign income, or any other form of income in the year that could take you over 200,000. So in the case of this doctor who has got £220,000 worth of total taxable income, he or she would have to be concerned, because what then happens is, because they've gone over 200,000, we take their £220,000 figure, we add on the pension growth, and then with a fairly convoluted computation, we potentially reduce the £60,000 pension input allowance. So we're saying because you went over 200,000, we have to reduce your pension input allowance. This is the price you pay for being a high earner or a super high earner. Therefore, my advice to my clients is bound to be, if at all possible, keep your total taxable income below 200,000. Because if you do, you guarantee yourself the full £60,000 pension input allowance, the best position you could possibly be in. This might mean that some sole trader businesses incorporate, so they take sole trader profits away from their personal tax return and put them into a company. For some limited companies, it might mean that they have to restrict their dividends. Maybe just tighten the belt a little bit to make sure that your dividends don't take you over 200,000. It might mean for buy-to-let landlords that it's no good having this rental income anymore. You may as well sell the property because the rental income that you make is taking you over 200,000. The message is clear here. If we've been given this stroke of good news, if we've been given the £60,000 allowance, let's protect it and let's keep taxable income below 200k and not have to worry about tapering. So that's the first point from the budget that I thought was good news. And to me, that was the main bit. That was the bit where I thought this is bound to be one of the best budgets I have seen in my lifetime, looking at it from a doctor's perspective. But then they mention lifetime allowance. So I deal with this tax less often than I would with the annual allowance, but nevertheless, it's always a lingering concern that if your lifetime value of your pension pot exceeds the lifetime allowance, which is currently £1.07 million, and by the way, that's perfectly feasible for a doctor to reach that figure, the bit above £1.07 million is taxed at 55%, another tax, a difficult tax. And this is where you get doctors saying, well, if my pot's already worth more than that, and I'm just walking into a 55% tax bracket, and by the way, I'm already on the highest grade of pay, I may as well not bother. I may as well come out of the NHS pension or just retire altogether. Well, the fact that they've decided to scrap this lifetime allowance is wonderful news as well. Because in theory, the doctor can carry on working. He's got to be mindful of the annual allowance pension taxes, but can be fairly blasé when it comes to lifetime allowance and just grow the pension pot as much as they want without this worry of a lifetime allowance tax catching them later on. And the fact that that has been abolished is particularly good news again. Combine the two, you'd have to say, and this is certainly the feeling I'm getting from my clients at this early stage, you'd have to say that this is the bit of news that doctors so desperately needed. I found it quite interesting myself, and this is not necessarily a tax point, but if we have lost doctors from the NHS and the government believes that these pension tax changes will bring them back into the NHS, is that enough? Yes, the numbers make great sense, of course they do. But post-COVID, have people become accustomed to a better way of life? Perhaps they have. Perhaps life in the NHS is so stressful there isn't enough tax relief out there to tempt you back in. And we'll soon find out if people do want to go back in. And it may be that it wasn't just pension taxes that were the worry. It was the NHS generally that was upsetting people. But I will watch on with real interest. What I can say from a financial perspective, though, is this is a move that is bound to help. So that was the main couple of points from the budget. If we just scroll down here to another point that was reasonably interesting, was the corporation tax rise. So I did hope in the back of my head that perhaps they would not bother going ahead with this corporation tax increase, but we can't have everything, and they are doing. So from the beginning of the new tax year, 1st of April 2023, the corporation tax rate will increase from 19% to 25%. And as it says here in this really useful article, actually, it says the tax rise will hit businesses with profits more than 250k. So if your profits are more than 250k, you can expect to pay 25% on the profits above 250k. If your profits are less than 50k, then the bit above 50k is taxable at just 19%, so no change. And the bit in between, the profit between 50 and 250, will suffer a marginal rate of tax, which is yet to be confirmed. But clearly what we're saying here is there's an increase in the rate of corporation tax. Now, if we then put that alongside this pension tax change, and this is, again, it's early days, we will have to just monitor the situation, but if we know that corporation tax rates are going up, we know that inflation is relatively high. We expect it to reduce by the end of the year, apparently, but as things stand, it is relatively high. And we know there's a little bit of pension leeway. I do wonder if there are some doctors out there, especially those who are nowhere, who are perhaps short on their pension savings, would there be an opportunity for a limited company doctor, so somebody providing private practice services via their limited company, would it be worth them taking some money out of the business and topping up their pension every year to get to around £60,000 worth of inputs? So let's say the NHS growth was 40,000. Could that doctor say, well, I'll take another 20,000 from my company, put it into my pension pot, taking me up to the £60,000 limit, so no tax payable on that, and the £20,000 top up that I have made would attract corporation tax relief at potentially a high rate. Remember, previously, for every £1 of pension contribution that a company made, there was 19 pence tax relief. Going forward, that could be 25 pence tax relief. And if the pension rules are enticing you in, well, so are the corporation tax rates as well. It's nice to start these new blog posts, I guess you might call them, with a positive story. I hope they continue. If anyone's got any queries, please do let me know, and we will monitor the situation and keep you up to date with how things go. I look forward to hearing from you all. Have a good weekend, and thanks for listening.